Google already runs the browser you use, the phone you carry, the inbox you check, the map you navigate, and the search engine you rely on for everything. They don't need Gemini to kill ChatGPT or VO to reinvent filmmaking. They just need AI to improve margins, defend moats, and enable a few more levers across their empire. They built the kitchen. They own the gas line. They manufacture the stoves. And they're selling meal kits to their competitors. Let's talk about it. Every few months, a new, most powerful AI model ever is announced, trained on enough computing power to run a small country. It's chaotic, it's theatrical, and it's deeply unsustainable. On the surface, it looks great. Valuations flying, startups flaunting frontier models every 6 months, along with collaborations that seem circular. Money shuffles between balance sheets, often returning to its origin with a fresh headline. This is why people talk about an AI bubble. It's not that AI isn't real, but much of the business logic seems shaky. Deals are inflated, and companies often have close, tangled relationships. Most startups use cloud credits to pay for computing, renting the same limited resources and hoping demand grows before costs catch up. While other companies compete for attention with flashy demos and billion-dollar model launches, Google's so-called boring AI strategy is about building and controlling the infrastructure, staying ahead of those chasing the headlines. To get a picture of what's going on in the economics of AI right now, let's look back a little. Take Wework, for example. Its sky-high valuation collapsed when it went public because its business model wasn't sustainable. Some AI startups face a similar risk, relying on cloud credits to boost their value. Research from Scara highlights the explosive growth of specialized cloud GPU providers as the demand for AI compute has surged. Coreweave generated approximately $465 million in revenue in 2023, up dramatically from roughly $15 million in 2022. That's a 30x year-on-year increase. This growth was driven almost entirely by hyperscale demand for Nvidia GPUs, with Coreweave pivoting from crypto mining infrastructure into AI-optimized cloud compute at exactly the right time. Unlike traditional cloud providers, Coreweave focuses narrowly on GPU availability, fast provisioning, and high-density workloads, making it an attractive alternative for AI labs and enterprises struggling with GPU scarcity on Amazon Web Services, Azure, and Google Cloud. This revenue spike shows how much AI startups depend on cloud infrastructure, especially for GPUs, making their business models vulnerable. Against that backdrop, Google looks completely separate, and that's the point. By my reckoning, Google isn't trying to win the AI debate anymore. Instead, it's setting the rules, shaping the industry to fit its own goals. By offering better incentives to developers, to advertisers, and cloud customers, Google makes its platform essential. Developers get a solid set of tools, advertisers get powerful insights from AI analytics, and cloud buyers get affordable, scalable options. This approach not only keeps Google in the lead, but it also makes its technology the foundation for future innovation. While others compete over building the smartest model, I see Google doing something different. They're arriving to own the conditions that make conversation possible. And that's the thing most people are missing. Google isn't treating AI like a product. They're treating it like infrastructure. And that's what makes them dangerous in a way that doesn't look loud or flashy. It looks boring until it isn't. By comparing past examples like Amazon Web Services' unassuming emergence in the early 2000s, we see how silent infrastructure plays can quietly amass dominance. During a decade when AWS operated mainly in the shadows of flashier tech competitors, it quietly built an impressive infrastructure, an empire that would later reshape cloud computing. This tactical patience demonstrates how boring approaches, though understated, can orchestrate monumental shifts in sector terrains. Allow me to explain. Most AI companies today are model labs. They live and die by 4 things: how good their next model is, how fast they can train it, how cheaply they can serve it, and how convincingly they can wrap it in a story for investors. It's an exhausting treadmill, and it's brutal if you don't control your costs, which is frankly most of them. That's where Google appears to be distinguishing itself. Gemini, covering model, brand, and platform. It's not Google's standalone core product as GPT is for OpenAI or Claude is for Anthropic. Instead, it signals a fundamental strategic difference. Google's value is an integrated system, not a single high-profile model. Google owns the chips that train the model, the data centers that run the chips, the networks that connect the data centers, and the software that orchestrates the clusters, the models themselves, and the applications that reach billions of devices. That's not owning the stack, as the catchphrase goes. That's owning the physics of AI deployment. Whilst most companies rent their infrastructure, Google builds and owns its own, giving it a significant long-term advantage. According to a report from MyTrade, Google plans to invest $75 billion in AI infrastructure in 2025-2026, which is 29% more than Wall Street expected. This shows Google's commitment to operating on a much larger scale than its competitors. The Information, a global tech, finance, and media publication, also reports that Google's per token inference cost is much lower than what rivals pay for rented GPUs, showing a big difference in cost efficiency. This long-term advantage, as industry analysts point out, makes Google's position even stronger. A quick pause. If you're into thoughtful tech and AI analysis like this, take a second to like, comment, and subscribe, or share it with someone who might enjoy it. It's a small click for you, but a big nudge for the algorithm gods. Let's talk about an essential factor in all this. TPUs, Google's tensor processing units. Because if you want to understand why Google's position is more dangerous than it looks, it starts with silicon. For years, TPUs, Google's custom AI chips, were treated like an internal curiosity, a bespoke tool for search, ads, YouTube, and maybe some cloud customers. That framing is now dead. TPUs are no longer a sideshow. According to IT Pro, Google's in-house development and oversight of its TPUs, manufactured through TSMC, allow the company to avoid global supply chain bottlenecks and secure exclusive access to its chips, giving Google an advantage over competitors that depend on limited Nvidia supplies. That gives them something almost no one in the industry has: predictability. Predictability of cost, predictability of scale, and it's not just about compute. Gemini 3, Google's latest top model, is important, less for its intelligence and more for how it was rolled out. While companies focus on highlighting their model's abilities, Google chose to quietly add AI to its existing products, making the whole ecosystem better, instead of just showing off the model's smarts. Gemini didn't just launch with a demo. It launched across the Gemini app, Workspace, Cloud APIs, Android, pricing tiers, caching infrastructure, searching, and maps grounding. It was about turning intelligence into a capable infrastructure. Google wants to win by making every product it already owns smarter. Gemini is just the interface. The real product is Google itself, upgraded with inference attached. Now, let's zoom out to the creative tools. On the surface, things like Veo, Imogen, Nano Banana, and Genie all look like a scatter of fun R&D projects. Video, images, simulation, editing, and the stuff that makes good YouTube shorts. But again, that's the surface level. Look underneath, and you'll realize each one is a different way of asking, can our infrastructure handle this? Can we generate video with synchronized audio at scale? Can we generate high quality images that understand typography and not just vibes? Can we simulate interactive worlds for agents to train in? Can we make this stuff usable in real workflows like ads, slides, docs, and phones? It's Google pushing the edges of its infrastructure and making sure it scales before it bets big on any one modality. And then there's the final piece, and perhaps the most powerful one: distribution. Most AI companies struggle to capture user attention. They require OEM deals, enterprise pilots, developer ecosystems, and app installs. People must actively choose to engage. Google doesn't have this problem. According to Cropping, as of 2025, over 3.45 billion people use Google Chrome as their primary browser, spotlighting the company's vast reach. Google already runs the browser you use, the phone you carry, the inbox you check, the map you navigate, and the search engine you rely on for everything, from finding restaurants nearby to searching for survival tips on how to survive a bear attack. Most AI companies must negotiate for user attention. Google just appends it. From a competitive standpoint, that's almost unfair. But does this mean anything for us, the end user? Of course. AI can quietly add value to everything people already do. This smooth integration can change how people behave and how markets work by putting AI at the center of daily tasks. Users might start relying on these tools without really choosing, which can shift what people expect and how companies compete. For businesses, this is very effective, but it could also mean that people have less control since they might depend on AI because other options fade away. This could make some uneasy about losing autonomy, as these systems might end up shaping decisions instead of just helping. Some experts warn that widespread AI use could reduce independence, whilst others argue it helps users by making tasks easier and offering new ways to make decisions. While companies clearly benefit, it's important to keep an eye on how this affects the user's control. Now, let's bring this back to the bubble. The real question isn't who has the best model. If the AI bubble bursts, even just a little, the companies that survive will be those that manage their costs, don't rely on constant rapid growth, and have infrastructure that keeps creating value even if expectations drop. For Google, a slowdown might mean slower growth in AI projects, but it could also be the chance to strengthen its market position as weaker competitors struggle. For example, if we compare Google to a typical company that rents GPUs, Google's integrated operations and control over its AI stack would help it keep steady. A competitor that rents GPUs could face higher expenses and might have to make significant changes just to stay afloat. In a full market crash, Google could focus on improving workflows and leveraging its strong infrastructure to weather tough times, whilst others might have to cut costs or change direction completely. In these ways, Google stands out from almost every other AI company. They don't need Gemini to kill ChatGPT, or Veo to reinvent filmmaking, or Genie to give birth to the metaverse. They just need AI to improve margins, defend moats, and enable a few more levers across their empire. Everything else is an upside. So yes, when people say, Google be cooking, they're right. Google isn't just cooking, however. They built the kitchen. They own the gas line. They manufacture the stoves. And they're selling meal kits to their competitors. What do you think?